Hi, I'm Gerry. I'm with the Insurance Council of British Columbia. Am I working the presentation, or is it working itself? I guess I'm working the presentation. I got 4 things to talk about today. Recent changes that we're dealing with in British Columbia. One deals with the introduction of mandatory supervision for new life agents, duties and obligations of a retail brokerage firm, managing general agents, and the last thing, which I'll touch on quickly, is just the sale of exempt securities by life insurance agents. Last week, we published a paper which proposes to amend Council's rules, which will introduce a new license condition for all new life insurance agents coming into the industry in British Columbia. Basically, what we're saying is that all new agents will be required to be under the direct supervision of a qualified agent for the first 2 years of their career. It is something that we have been looking at for a number of years now and felt that it was time to take the next step based on the work that we did earlier in the decade when we introduced the LLQP. We knew that was a good step in the direction we wanted to go with bringing on new agents, but we knew we needed to do more. And we had looked at different options, but the option we figure is the most appropriate is to have a mandatory requirement for supervision. We were comfortable with this because we looked at the way the industry is operating right now, and we feel that by and large most people coming into the industry are coming in with some type of supervision, either working for an agency. Of course, there are still career company models as well. But we were concerned that it was possible for somebody like me, let's say, to go out, and if I could pass the LLQP, and if I could find somebody to give me a contract, I could start working the next day, working from my home, working independently with nobody looking over my shoulder. And we felt that was not in the best interest of the public or the best interest of the industry, for that matter. So what we're doing is we're talking about new agents. New agents is someone who's never had a license before, or if they were licensed before but have left the industry and have to come back, or coming back into the industry, and Council determines they must start over again as far as requalification. I will apply to both resident and non-resident agents equally. And the supervision part of it will have to be done by someone who we're deeming to be qualified, and qualified in a general definition is someone who's been licensed for a minimum of 5 years. We have published this on our website. It went up last Tuesday, I believe, a week Tuesday. And we're in a comment period, so because we are going to be amending our rules, it is up for 60 days. We will look for the feedback. Once we receive that feedback, we'll move forward from there. Some of the things, the biggest issue, it's amazing when we've talked about this, people have said, well, what do you mean by supervision? I've sort of felt the supervision, it's the same in the insurance industry, it is in the regulatory industry as it is in every other industry. We expect supervisors to know who it is that they're supervising and establish prudent guidelines. Ideally, I would have liked to have called it a mentorship program, but unfortunately in the regulatory world, mentorship would have created even more challenges than the word supervision, so we stuck with supervision. But what we're really looking for, of course, is for new agents to be guided, to be trained, to be taught the things they need to do, both to be good agents to their clients and also to help them develop as they go forward. So we'll be looking for supervisors to develop prudent guidelines. We'll be looking for them to do the mentorship part, teach them how to do the proper documentation, file maintenance. And the supervision itself, though, can vary. I mean, obviously, once you bring somebody on, your level of supervision is the same as it is for all of us. As an employee demonstrates that they're qualified in what they're doing, then the level of supervision that you exercise over them usually declines as they show their competence. And we'd be looking for the same kind of a process. We're not saying that for the first 2 years you must look over the shoulder of everybody you're supervising all the way through that 2-year period. Obviously that's going to be guided by how well they're doing, the knowledge they're showing, the types of products they're selling. The second thing we're dealing with, of course, is the responsibility of life insurance agencies, the retail agency, as well as nominees. We have spent a number of years dealing with this on the P&C side. We've dealt with it with adjusters, but Council's never really come out and said to life insurance agencies and the nominees, which are responsible for these agencies, what their obligations are. So we expect probably by February we will have posted guidelines to the retail side of it, saying, look, here's what our expectations are. One of the things that we are going to be telling the retail broker is, if you have an AGA contract, an associate general agent contract, you will be accountable for the business that is coming through your organization, through that AGA relationship you have with other agents. So the responsibility will be greater. We are viewing AGAs as being different than MGAs. So we will clarify what our expectations are and what our goals are in that area. The nominee, of course, is always accountable. The nominee is someone who is equivalent to a qualified supervisor. We require nominees to have at least 5 years insurance experience before they can be the nominee of an agency if that agency has more than one agent working for it. So we will come out and provide guidelines. We'll probably even develop up a training course for nominees. We have one on the P&C side, and we figure it would be useful to have one on the life side. We find that when we are talking to nominees, most of them aren't even aware of some of the basic requirements council has with regards to its rules and the usual practice of the business of insurance as council views it. So we will develop up some kind of course to assist in that area. Again, some of the same things we were just talking about a minute ago. The roles of agencies and nominees will be, of course, to supervise the business that is going on, to make sure they have appropriate compliance procedures in place. We are also going to say, though, that they have a requirement to be knowledgeable of the non-insurance activities that are going on within their agency by insurance agents, particularly the exempt securities market. I will touch upon that briefly at the end because Council has published a paper on that as well. The last one in the area is the managing general agents. This is something that has been discussed and has been looked at over at a national level for the last 3 to 4 years. It was something that Council started looking at about 5 years ago. We opted to become part of the CCIR discussion as well. We are hoping and expecting that that will come to completion in the near future, but Council had determined that it wanted to go ahead and provide guidelines. We have a significant number of MGAs in our jurisdiction, and we felt it was appropriate that we give them a better understanding of what our expectations are as far as their license goes, because they, as you all know, the role of the MGAs is a much different one than the usual retail broker. So we're going to do such things as provide a definition, basically defining what an MGA is, and the quick definition is usually a corporate entity or a partnership that has a licensed nominee and has a valid MGA contract with an insurer. We tried to come up with a definition of what an MGA contract is, and it's a very simple one. If the word MGA is in the contract wording, it's an MGA contract. We're going to define the functions of an MGA and make sure that everyone understands what we look at. We see there's a number of things that are involved here. One, there is the duty to the insurer. We see that as a critical one. They are operating as an MGA because they have a contract with an insurer, and therefore our expectation is that they must live up to that contract, and if disputes arise regarding whether they are complying with that contract, then that could lead to an issue of suitability if it's proven that they're not complying with it. I've got down there, know you client. It should be know your client, or know your agent, sorry. The expectation is that, yes, they will have procedures in place. We are not looking for MGAs to supervise agents, but we are certainly expecting them to be aware of the qualifications and the abilities of the agents that are accepting business and do a reasonable review based on that. A good example would be somebody who comes to them. If they have an agent who they've been dealing with for 10 years, who has basically only done term insurance in about a whole life, and that's all they've done, and they've been satisfied with that, then we would expect that the level of review for the business coming in would be very slight. But if all of a sudden that agent starts bringing in disability business or CI business or something else, which they've never seen before, our expectation is that the MGA would start asking questions. Why are you doing this? Where is this business coming from? What are your qualifications? If they say, look, well, I've been dealing with another MGA on this for the last 15 years, not dealing with them anymore, I want to bring the business to you, I think then they can rely upon that information. If they say, well, I went to a continuing education seminar 3 weeks ago, and that disability stuff looked really good to me, then I think we would expect the MGA to be a little more satisfied that they have the qualifications and know what they're dealing with. We expect to publish, and also there's the obligations they have to the consumer, which are much more muted, I think, than what we would expect from a retail broker. The last thing we're also going to expect of them is we see this as an opportunity from a regulatory standpoint, to have better oversight. One of the biggest challenges we've dealt with at Council has been the lack of willingness to report problem agents to Council. I was interested when I saw some of the feedback we got on the MGAs, that most MGAs felt their obligation was to simply let the insurer know of a bad agent and not to report to the regulator. We're going to make it very clear that we think they do have an obligation to report problem agents to the Council so that we can take prudent steps in dealing with that. The last thing, well, first of all, a couple of points that we're not going to deal with. We're certainly not going to make MGA supervisors, I've made that clear, or even accountable for the day-to-day activities of agents, but they will have a certain oversight role. We're not looking to limit the activities of MGAs or restrict how many MGA contracts can be held. And we're certainly not looking to limit the number of MGAs a life agent can do business with. We realize that not every MGA can provide all the services, so those are things that are not on the table. We certainly see that's how the industry is operating now, and we're not looking to change that. The last thing I have is the sale of exempt market securities. We've seen a significant increase in the number of exempt market securities that are being sold by life insurance agents. We published a paper in July this year. We focused it primarily on life insurance agents that did not hold a securities registration. Many of them in our province are relying upon an exemption that does exist. But Council has come out and said, look, we do not believe you can rely on that exemption because that exemption requires you basically not to make a recommendation, not to do any know your client. We do not believe that is possible for a life insurance agent to sit there and say, look, yes, they're an insurance client of mine. No, I didn't do any assessment of whether this was appropriate for them. The client does not understand the difference. They believe they're getting good advice. They're relying on the fact that this person is a life insurance agent. So what we're saying is, no, you must do a proper due diligence. You must know whether the recommendation is appropriate for the client, and which case means you cannot rely on that exemption. Anyway, that was something that we published, I believe, in July this year. We have already had to deal with, I think, 3 different cases of what Council determined to be inappropriate sale of an exempt product to a client. The last one, actually, Council terminated their license for a minimum 2-year period because they felt it was a very inappropriate recommendation. So it is one of the things that is certainly on the forefront. We're seeing more and more of these types of issues coming forward, and that's why we provided some guidelines as to what we thought was appropriate. And I believe that is my 15 minutes. Thank you very much.
Well, good morning, everybody, and thanks to Ed for that very kind introduction. Like Gerry, I've never before been confused with a rock star, so it's a nice shot in the arm for this morning. I want to thank Advocis for inviting me to participate in today's panel. It's a pleasure to be here with my regulatory counterparts from in the insurance and the pension area. So I thought it might be helpful to discuss 4 areas of activity at the Ontario Securities Commission which are relevant to the overall theme of this panel, which is convergence. And those areas are, first of all, the international context of securities regulation today. Secondly, a quick word about investment products. Thirdly, the role of the advisor. And finally, just a comment about investor education. So I also have 15 minutes, and I'm going to give you a 30,000 feet overview of certain areas of regulatory focus which I think might be relevant to advisors and to the distribution of investment products more generally. I should also start with the standard disclaimer that the comments that I'm making this morning are my own views and don't necessarily represent the views of the Securities Commission. So, and if you believe that, I've got some swampland in Florida for you as well. Okay, so the international context. We all know that it's a cliche that global capital markets have experienced enormous changes over the past 15 years. There have been significant changes in the breadth and the complexity of products, and including, and here's the reference to convergence, much more blurred lines between products across the banking, the insurance, and the securities sectors. There have also been significant changes in market infrastructure, an increasing interconnection among global markets, as well as a growing understanding of the importance of securities regulation to financial stability more generally. So it's clear that the context in which the OSC and other financial market regulators are doing their jobs is much more complex, and also challenges the frameworks and the approaches to securities regulation that we've historically relied upon. In part, as a result of the global financial crisis, more international bodies are interested in securities regulation, and they're interested in how it fits into a broader picture about financial stability. Financial regulators are now required to actively monitor the so-called perimeter of regulation for gaps and for overlap as new products, strategies, and business structures make their way into the market. And as I say, we need to be willing to change established approaches if they no longer provide an adequate level of investor protection in the market. So since the financial crisis, securities regulators have been working more closely with prudential regulators and central banks to address systemic risks in the global markets. The International Organization of Securities Commissions recently identified the reduction of systemic risk as one of the 3 core objectives of securities regulation. So the management of systemic risk has moved directly into the orbit of the OSC and its counterparts in other provinces of Canada. This has, of course, implications for our regulation of financial products and of market participants. We're dealing with a broad range of issues that have international dimensions. You've undoubtedly read about our concerns about emerging market issuers going public in Canada, and the modifications that we may need to make to our traditional approaches to disclosure to acknowledge that new reality. The development of a regulatory framework for over-the-counter derivatives is also an example where we need to be very attentive to what's going on in other jurisdictions. Those transactions obviously are global in nature. So one of our biggest challenges is to make sure we have the capacity to keep current with new market developments in Canada and elsewhere. Finally, Maple Group's proposed takeover of the TMX Group is a good example both of convergence in the context of market infrastructure and the need for securities regulators to have a clear grasp of the implications of changing that market infrastructure for investors and for market participants. So let me turn a little bit more specifically to the question of new products. I mentioned that a key feature of our new reality in Canada is the complexity and the proliferation of investment products, and this is something that Gerry's already referred to as well. In the last 10 years, the offering of non-conventional investment funds, particularly exchange-traded funds, has accelerated. ETFs' asset under management have increased more than 5 times from approximately $6 billion in December 2000 to more than $40 billion this year. So the trend has been towards more complex ETF offerings and structured products that test the boundaries of our rules. One example is ETFs that make significant investments in derivatives to provide retail investors with access to new asset classes and complex investment strategies. The dynamic nature of the investment funds industry requires OSC staff to constantly respond to rapid product development and innovation. So at the OSC, our operational and policy work is focused on responding to product and market development, as I said, making sure that disclosure is appropriate. And as I've said, disclosure is a cornerstone, traditionally, of our regulatory regime. But given the changes that I'm mentioning, we need to ask ourselves, does the way that we've been doing disclosure or regulating disclosure in the past go far enough to protect investors? And some of what I'm talking about here ties into the research that was presented in the earlier panel deriving from behavioral economics, which talks about the limits on people's ability to understand very detailed, very comprehensive disclosure. So Howard Weston, the chair of the OSC, likes to talk about the fact that we need to focus more on comprehensible disclosure as opposed to comprehensive disclosure. So providing better information, not just more information, can help investors, we think, make better choices. The introduction of fund facts in the mutual fund space was an early step to a new approach to disclosure. As you will know, as of January 1st of this year, mutual fund companies are required to produce a concise, easy-to-read document for each of their mutual funds. We're calling that fund facts. The objective here is to provide investors with key facts and information in a simple, comparable, and accessible format at a time that's actually relevant to their investment decision. So those principles about comprehensible disclosure that underlie the Fund Facts initiative are equally relevant to other types of investment funds, particularly those products that I mentioned earlier that are increasingly popular with retail investors, such as ETFs. The key, though, is to develop a document that can be tailored for each specific type of fund. So going forward, the OSC will consider similar types of more accessible disclosure documents for other publicly offered investment fund products. The rapid growth and innovation in the global ETF market is also causing regulators to review the risks related to those products, and that ties back into my comment about systemic risk earlier. For example, the increase in synthetic ETFs and the use of derivatives raise new challenges in terms of counterparty and collateral risks. So those risks that may arise in increasingly complex products need to be identified and effectively mitigated. The goal here, to sum up on this point, is to try to balance the benefit and the risks by encouraging markets to continue to innovate and to compete, but also taking steps to address the risks involved and do our part as securities regulators to promote financial stability. Let me turn now briefly to the role of the advisor, and obviously this is something that is very much central to your interests at this conference today. The discussion about investment products and risks, of course, throws up the question of the role of the advisor. And here I want to mention briefly two issues that are very much on the radar for securities regulators. One is the issue about suitability, and the other is the issue about fiduciary duty. Suitability, of course, refers to that fundamental process that you're well aware of, whereby investors and dealers are required to ensure that clients are investing in suitable securities. Advisors and dealers are required to take reasonable steps to make sure that the purchase or sale of a security is suitable for their clients. And to meet these obligations, and this was obviously referred to earlier, advisors and dealers are subject to the Know Your Client rule, as well as the more recent Know Your Product rule. And so, to make this absolutely clear, advisors and dealers are required to meet both the KYC and KYP requirements in order to make the suitability determination that's required by securities law. They must also have written policies and procedures in place to ensure that they can satisfy their suitability obligations. Let me turn then to fiduciary duty, which is obviously attracting a lot of debate both in Canada and internationally. And that debate is centered in large part around the benefits that a fiduciary duty in a statutory context might provide. The way that the debate is playing out in Canada specifically seems to be on the one hand, to suggest that some investors could be getting more customized, independent advice. Interests of advisors and dealers on the one hand are not always aligned with the interests of investors on the other. The current regulatory regime requires that advisors and dealers deal fairly, honestly, and in good faith with their clients. You all know that. If advisors or dealers have any conflicts of interest, according to the current registration rules, they must be controlled or avoided, or at the very least disclosed to the client. So if we are to move as regulators to the next step of imposing a fiduciary duty here in a statutory context, we have to ask ourselves, what is the problem that that introduction of that requirement would actually solve? Some of the flashpoints in the debate so far, and I emphasize that obviously no conclusion has been made by the regulators about this issue, would be, if we're going to introduce something like this, how broad should it be? Would it have the unintended consequence of reducing access to or the affordability of investment advice for retail investors? Would the duty require changes to the current compensation structure for dealers and advisors? So as part of our analysis, we are looking at other possible regulatory alternatives and gathering the facts related to those. So options short of a statutory fiduciary duty might include modifying advisor and dealer compensation structures, requiring clearer disclosure to clients by advisors and dealers so that clients understand when they're being given independent advice or when that advice might be subject to certain limitations. And although I wasn't here at the beginning of your discussions this morning, I gather this issue has already been canvassed, but we are, as securities regulators in Canada, very much aware that other countries are also looking at a variety of approaches and struggling with these issues. For example, the approach of requiring firms to make clear whether the advice they're offering is independent or restricted is the approach that's being adopted by the UK in the financial services, by the Financial Services Authority. While in Australia, government is introducing a statutory fiduciary duty there. So we need to look at what's happening in other jurisdictions, but also attempt to come up with a solution to this that will be appropriate in the Canadian context. So let me briefly, in the few minutes I have left, just touch on the question of investor education. Obviously, from our point of view as securities regulators, developing an educated and informed investing public is an important component of overall investor protection. The need to support investor education is even more critical given all of the new reality that I referred to earlier, the increased availability of complex products, greater reliance on the exempt market for distribution, potential conflicts of interest in the distribution of products. So the Investor Education Fund that is sponsored by the Ontario Securities Commission is working in a smart and an engaged way to develop and promote independent financial information and tools to help consumers make better financial and investing decisions. The OSC supports very much the work that the IEF is engaged in providing and expanding outreach initiatives in Ontario schools and generally strengthening the financial literacy of adult Ontarians. But at the same time, we're mindful that investor education cannot be the complete answer to achieving a securities market that is fair and effective. Sometimes regulatory action in the form of new policy and rulemaking is necessary. In this regard, the OSC is enhancing its focus on evidence-based policymaking, and I very much appreciate some of the evidence that was provided in the earlier session that I'm sure that the staff in this area will want to take a close look at. And when I talk about evidence-based policymaking, I mean the need to make new policy based on a clear understanding of the problems that are being solved and the consequences of changes. As part of this focus, we are mindful that in engaging in rulemaking, we need to consult with investors, and as a result, over a year ago, established an investor advisory panel, which is providing us with a broad range of investor feedback on proposed rules and policies. So let me finish then by reiterating that in the new capital markets reality, the OSC is facing, and we're well aware of this, growing stakeholder and public expectations. We're taking the challenge seriously. We're trying to take a more strategic approach to fulfilling our dual mandate of investor protection and fostering fair and efficient capital markets, and we're trying to develop our capacity to keep pace with market developments and the agility to respond with the right level of regulation. Thank you very much for your attention. I look forward to your questions.
Good morning, everyone. Thanks for the introduction, Ed. I'm definitely not a rock star, though I must confess I had this image go through my mind of the new regulators meeting, sort of regulatory rappers. I could see a very interesting way to do these speeches in future conferences. I'm really pleased to be here today. It's an important forum. I'm also pleased that several of my staff from FSCO are here. That's something that we encourage. It's useful not only to maintain and increase the effectiveness of our relationship with our stakeholders, but it's also a really useful opportunity to get a wide perspective of developments that are happening in the industry. So that's really useful to us as we conduct our job. So also thanks for the opportunity to speak today. This past summer, Rob Carrick in his column posed the question, when the financial advice business in Canada grows up, what does it want to be? And now he's being a little facetious and trying to arouse reader interest for sure, but it is somewhat relevant and it does tap into a key aspect of the evolving environment today, and that is that there is a lot of change and a lot of growing that is going on. And just like all of us, when we grow, it does mean making choices and choosing directions as you move forward with the growth. There's numerous forces that are at play that are affecting the shape of regulation in financial services industries around the world. I should note, late October, November is a pretty busy time for me in terms of attending these types of functions. Seems to be one point in the year when just about every industry that we regulate, and there are quite a number at FSCO, have meetings, symposiums, this type of a conference. And it's been really interesting to me this year, the commonality of themes across those. And many of the issues that you're grappling with today and that your agenda is addressing are exactly those that are informing the conferences of other industries as well. Today I want to offer some comments on some of the factors driving the change in your industry and some of the areas to focus on as you move forward dealing with this changing environment. I know one of the issues that's kind of interesting, maybe a little bit alluded to in some of the previous presentations today, when I'm going to use the term financial advisor, meaning someone who offers financial advice. I think if you talk to consumers today, you might find there's an awful lot of disparity of view as to what exactly that means. And I appreciate that there is a significant range of services that are offered, but that's what I'm talking about today. I think one of the striking things to note at the outset is that many of the forces that are driving change in your industry and that have implications for the way in which we regulate it have the interests of the consumer at their heart. And that's appropriate. I mean, your business is all about offering value propositions to your clients. This is leading to significant moves to develop more commonality of standards and indeed national standards for those who offer financial advice. And I think this is a trend that is going to continue to accelerate. It clearly stems from, well, it stems from a number of sources, but it certainly stems from consumers' desire for more clarity and better protection in dealing with financial advisors. In my view, the patchwork of various qualifications and supervision requirements, something that Gerry touched on in his remarks, across Canada is not sustainable. While local differences are always going to remain relevant, the forces in the world today are definitely pushing the bar higher, and those forces will continue. With a multitude of financial advisory designations, it's certainly easy to see how consumers are confused about who is an advisor, who is a salesperson, who is regulated, who isn't. Again, just quoting Rob's article in the summer, notice that we don't have accounting consultants, accounting planners, and accounting advisors. We just have accountants. So again, I think that kind of pressure and force is something that will continue. The growth in your own profession is worth mentioning, is giving consumers more choice when it comes to who they go to for financial advice. According to the Financial Planning Standards Board, the total number of certified financial planner professionals has more than doubled since in this past decade. It's also interesting to note that both before the financial crisis and certainly after 2008, government initiatives, for example, the Federal Task Force on Financial Literacy, have encouraged consumers to be better informed when choosing financial advisors. Important concept there. I think everyone has a responsibility, and certainly from our perspective as regulators, we also have a responsibility to kind of understand the whole picture in which we're operating. It's not just that you need to do more, you do, but consumers have a responsibility, regulators have a responsibility to understand the environment that we're operating in and to ensure that none of us really lose sight of what's most important at the end of the day, in my view, and that is the consumer. Consumers' expectations around appropriate service certainly appeared to be somewhat higher in the wake of the financial crisis. But I think the forces that were driving this changing consumer environment were in place before the crisis, and there's a range of issues, and perhaps a topic for another day. But I certainly notice the expectation of consumers changing. It's reflected in some tips that were recently being given to consumers asking for advice, in this case from a pension and benefits lawyer and other pensions, another area that we regulate, whose advice to consumers: get referrals from sources that you trust, but also take time, to verify professionals' credentials by maybe contacting the professional certification body to confirm he's a member in good standing. Interview a few professionals, either by phone or in person. Ask them to outline their qualifications and experience. So this just underscores the remark I made a few minutes ago, that the responsibility is not just on you, although critically you have a considerable role to play in ensuring that consumers' interests are protected, but consumers themselves also have to take some responsibility. There's a strong expectation, though, and this is real, and this is what you have to respond to, that people providing financial advice and financial services today know what they are selling. I think when it comes to consumer expectations, technology has been a game changer. It certainly has increased the variety of distribution channels and creates options for you. But consumers increasingly expect more choice when it comes to the channels that they use to obtain services. So you don't really have any choice but to respond. Technology, I think, also forces you to bring your A game. A Sun Life Financial article in your September issue of Forum highlighted how social media allows consumers to openly discuss the value of your advice. Of course, this makes it increasingly vital for you to maintain the highest standards of professional conduct. It also means that you're expected to be more engaged, more available, and more flexible. This is not a bad thing. Again, your number one focus should be your client, and they obviously will benefit from you stepping up. Another trend is the increasing diversity of your clientele. High net worth individuals are no longer the only ones seeking your services. Small business owners, recent immigrants, individuals trying to manage high debt loads and figure out how to move forward will be among those who will be turning to you for advice. As mentioned in one of the Forum's recent piece on the ideal advisor, these consumers have substantially different service expectations, communication styles, and responses to stress. All of which means that you and your business models need to be flexible and adaptable if you're going to exploit the opportunities that are offered in today's market. In today's global interconnected economy, there's also a need for all players in the financial services sector to understand that local practices will be affected by global developments. And again, there's a wide variety of ways in which this happens. Advocis certainly does a great job of keeping its finger on the pulse of what is going on across Canada. Events taking place around the world can also impact your business, though, and the future of your profession. On that note, the recent increasing international focus on consumer protection by various regulatory and supervisory bodies is significant. While much of the post-2008 financial crisis has been focused on institutional solvency concerns, The global financial crisis also left consumers, regulators, and various stakeholders asking whether all players in the financial services sector, including financial advisors, were really putting consumers' interests first. Recently, the OECD, the Organization for Economic Cooperation and Development, and the IAIS, the International Association of Insurance Supervisors, have highlighted the need for all stakeholders in the financial services sector to raise the bar in this area. As financial advisors, you and Advocis, your association, have been vocal about enhancing professionalism in the best interests of the consumer. And indeed, that's part of your mission statement. But this trend and focus on the consumer, on market conduct, which has an implication for us in the direction in which regulation will evolve, is not something that is going to go away. As members of Advocis, you have a strong voice. Yeah, your advocacy has resulted in changes to proposed legislation and influences the development of public policy. Your advocacy, coupled with the evolving nature of your profession, puts you in a unique position, and you have the power and the flexibility to be leaders in enhancing consumer protection and education. And indeed, I would argue that you have that responsibility as part of your business. At a time when all players in the financial services sector are expected to do more, this really represents an opportunity for you to both enhance your reputation, increase your influence, and presumably increase your sales. Specifically, I think financial advisors should be striving to be trailblazers in a couple of key areas: fair treatment of consumers and financial education and awareness. Let me just expand briefly on those. The international financial services community has recognized the fair treatment of consumers as critical to a well-functioning market. And it's important to recognize that its interpretation of fair treatment is becoming increasingly broad. Treating consumers fairly goes beyond obeying the law and complying with the letter of the regulation, in my view. The IAIS's revised insurance core principles describe the fair treatment of consumers as achieving outcomes such as developing and marketing products in a way that pays due regard to the interests of consumers, providing customers with clear information before, during, and after the point of sale, reducing the risk of sales which are not appropriate to customers' needs, ensuring that any advice given is of a high quality, dealing with customer complaints and disputes in a fair manner, protecting the privacy of information obtained from customers, managing the reasonable expectations of customers. That's a pretty tall order. But I think what it's really about is doing everything you can to act in your client's best interest at all stages of their relationship with you. It takes effort, it takes responsibility, and it definitely takes vigilance on your part. To act in your client's best interest, you may need to go a little beyond what's written in a policies and procedures handbook that you might have. Indeed, you may need to rewrite parts of that handbook going forward. For example, you might be noticing that your customers are having difficulty understanding a particular product. To ensure customers are being treated fairly, it's important that you try and find out why and not snow them. I mean, is it the company information that's the manufacturer information that's the problem here, or is it just the sheer complexity of the product that's the issue? You know, where you believe that company information or products themselves may be problematic, it's critical for you to find ways to bring that to the attention of the product manufacturers. I think I was struck, Gerry, by your comment on the MGA and the role where you see it going, because I think really what you were saying there, it's not about necessarily establishing a whole other set of rules and processes that MGAs must comply with, but it's almost using common sense to recognize that they can enhance the value of the agent services by just going that extra mile and engaging in some kind of, using some judgment to determine where some additional supervisory insight is required. And I think it's really beneficial to you as an industry to recognize that kind of approach, because I would argue, given the global regulatory pressures that are out there, in the absence of stepping up and taking a bit more responsibility to use some judgment, engage a little bit more than you may have in the past and go kind of outside of your legislated regulatory responsibilities. If you don't do that, you'll be in an environment where there's going to be more and more regulatory responsibilities forced upon you. The IAS core principles also emphasize that the basis on which a recommendation is made should be explained and documented, particularly in the case of complex products. Fairness means ensuring that your information and advice is appropriate and takes into account consumers' disclosed circumstances. I'm sure you'd agree that the advice and information that you would provide to a medium-income consumer with a significant debt load must be different than what you would offer to a high-net-worth investor with a large portfolio. Secondary is financial education and awareness. The need for more financial education and awareness is being widely promoted by almost all the players in the financial services sector. While the attention is refreshing, I think we still have a long way to go. All players in the system, and this includes financial advisors, again need to go beyond paying lip service to financial literacy. Guidance in the insurance core principles highlighted the important role you have to play as intermediaries in promoting financial awareness. Your direct interaction with consumers places you in an ideal position to do this. You are the people who are there when they are making the financial decisions. As a result, it's important to ensure consumers are aware of the products available to them and understand their purpose, how they work, and what the key features are. This understanding helps consumers compare products and helps them purchase products that meet their needs. This is especially important when dealing with more complex financial products, where people will tend to rely more heavily on you and your advice. It's worth emphasizing that initiatives to promote financial awareness can have a positive impact on your reputation, but only if they are conducted with professionalism. And at the heart of these initiatives should be the desire to educate your customer. While these initiatives may be tied to marketing campaigns, which is obviously a completely valid part of your business, the more neutral they are or appear, the greater the chance that they will be taken seriously. So what does it all mean for you? Well, you want to play an active role in enhancing professionalism in your field. I think that's a given. This means taking personal responsibility, particularly when it comes to ensuring that consumers are treated fairly and in promoting financial education and awareness. It also means understanding and remaining aware of changes in the environment that you operate in. The financial crisis highlighted the interconnectedness of the global economy, and in its wake, governments and regulators are focused on how the public interest can be better served in the financial services sector. To continue to capture the attention of government and the regulatory community, you, along with other players in the financial services system, must demonstrate that you are acting in the best interest of the public, and that means acting in the best interest of your customers. Acting in the public's best interest involves ensuring consumers have more clarity when they are seeking financial advice. It's important for them to know when they are talking to someone who offers comprehensive planning, when they're talking to someone who offers advice in the context of personal finance, and the difference between the two. When they're engaging financial advisors, they should also know what specific services they can expect from you. As it stands, consumers who want financial advice currently have to wade through dozens of professional titles and designations, which represent differing interests and certainly represent different capabilities. As a result, media and regulators have published lists of questions that consumers can use to determine whether or not they are talking to a financial advisor. Efforts to address the fractionalism in your profession would definitely benefit customers. They could also provide financial advisors with a stronger, more unified voice. I think my message today is pretty simple. Put consumers first, put your customer first, and you'll enhance your reputation and increase your influence. Be innovators, be leaders. Most importantly, take responsibility for the fair treatment of consumers and act in their best interest. After all, delivering a value proposition to your clients is what your business is all about. Thank you.
Hi. We'll open it up to some questions for the panel, but before we do, I want to answer, I think, the question on everybody's mind. Rob Pegueraro from Fisco was telling me that Phil's office rapper name is P-Dog. So that's what he likes to go by, but that's apparently a quiet sort of secret shared with everybody. And I want to let Gerry and Mary know that we have a really good marketing department at Advocis, and if you guys are looking for stage names, we can come up with them.
Thanks, I'll take you up on that.
So if anybody has any questions, please feel free to come up to the microphones and ask them. Oh, I thought that was somebody working their way to the microphone. I do have a. Sorry, we have a question.
Hi, it's a question for Mary. What exactly do you mean by fiduciary?
Well, you put your finger on part of the core debate here. I think that the traditional definition refers to not just acting in the interests of your client, but putting those interests ahead of your own, right? That's the kind of legal understanding of the other context in which fiduciary duty has been established, which is in the corporate director area, the pension trustee area. So actually, putting your client's interests ahead of your own. And so how that actually plays out in a variety of detailed contexts, I think, is the challenge for the regulators to figure out, because I think that would that would move people to a position that perhaps they haven't necessarily given full attention to in the past.
John?
Thank all the speakers for their presentations. I thought they were all very good. I'd like to just address a contrast in Gerry's presentation and Mary's. What comes across very definitively is the sort of the light touch mentorship approach to oversight in the insurance markets versus the high touch approach that the securities regulators tend to take. And Mary, you didn't mention the SROs and their role in all of this. I like to call them the delegated regulatory organizations, not self-regulatory, because I don't think, particularly at the advisor level, that we have 1 ounce of impact on that. Typically, it's the trade associations, the dealers and so on that have the greatest impact. And advisors that are moving more in terms of a higher level of duty of care to their clients often find themselves in conflict with the values that are propagated by both the dealer community and the regulators surrounding that. And there's not a very, very good fit. So I'd like you to comment just on, you know, the SROs, when they come in and audit our firms, they're typically not people from the investment industry, but lawyers and accountants who are looking for checklists, have no industry experience. Whereas in Gerry's approach, they're relying on the industry wisdom to be passed on through the generations in a more professional sense. And there's flaws with both, because I don't think the proficiency standards on either side of the game are really up to scratch, and we never see regulators addressing that in its importance. So I think in our efforts to kind of raise the bar and bring new professionalism to the industry, perhaps we should be considering an SRO for advisors, professionals, as opposed to distribution channels. And I'd like you to, maybe if all three of you could comment on that, I'd appreciate it.
Yeah, we take the attitude of walking quietly and carrying a big stick, I guess. In BC, we've certainly tried to come up with ways in which we can encourage the industry, provide guidelines. We have the luxury in our legislation where basically counsel gets to determine somebody's suitability, their trustworthiness, competence, the ability to carry on business in good faith and in accordance with the usual practice of the business of insurance. And it's that usual practice of the business of insurance which gives us the ability to come along and say, okay, here is how we envision this conduct should occur. Here's how you should do these transactions. But at the end of the day, we play the Monday morning quarterback. I mean, we come along and we say, here's how we think you should do it. Things such as making sure you're putting your client's interests first, making sure you have proper documentation. We stayed away from things such as the know your client forms that you see on the security side, primarily because we do not think you can come up with one. There are too many diverse products involved. So the more specific you try to get into regulation on the insurance side, we found there was many challenges there because there are just so many different products that are being sold. So what we're saying is, look, here's the conduct we expect to see, and then clearly when we get a complaint, then the issue is to look at how that transaction has occurred to determine whether or not it was appropriate in the circumstances. We are now starting to take on a role of doing inspections, which you do see on the side of the SROs on the security side. We are luckily being able to hire people in the industry, so we're sending them out who are from the life insurance industry or from the P&C side, depending on what we're looking at. But it's a balancing act. I mean, you know, you can create all the rules in the world, but at the end of the day, a bad agent's a bad agent, and they're going to find a way around the rules. So we walk that line, and I don't know whether it's the right line or not, but it's the approach we're taking.
If I can just jump in too, I don't want to get in front of Phil necessarily, but you know, certainly the idea of creating an SRO for the advisor channel is very interesting. I haven't heard that articulated before. I think, you know, in one way, it would be a natural evolution in the sense that you do see those kind of self-regulatory organizations getting established when there is a kind of a base level of professionalism in a particular area that now can be actively involved in regulating itself. So I think that's an intriguing idea, and you know, would be happy to take it back to the regulators to think a bit more about it. On the couple of the other points that you make, and this sort of ties into to Gerry's point about, you know, rules and policy is one thing, but actually implementing them on the ground is another. I think that certainly the securities regulators pay quite a lot of attention to the question of compliance. That is, you know, trying to get a handle on whether rules are being complied with, whether procedures are being put in place to implement those rules right in the, you know, at the interface of that relationship between the advisor and the client. And but your other point, which is, you know, what is the approach, the oversight approach that is being taken to monitor that compliance? I mean, I can only take your point that there are a range of professional experiences and expertise, types of expertise here that are relevant to that assessment of whether there's adequate compliance. And it could be that lawyers and accountants are clearly not the only types of professionals that can do that work. So so my reference in my remarks to the question of the OSC trying to build capacity to respond to market developments is in part a reference to the fact that we need to have a range of professional experience across the spectrum to be able to understand, you know, how derivatives are being used in products and what kind of what would be the appropriate modifications for the advice channel that would be useful. So I take that point. It's a very valid one.
I agree with what both Mary and Gerry have said. And that was a very good question. Sort of addressing self-regulation versus legislated, mandated regulation, whether it's rules-based, principles-based, whatever you want to call a formal regulatory regulator. The key thing is to really understand why is the regulation needed, and to ensure that there's a consistency of views on the part of the various players. In this case, it would be industry, stakeholders, and consumers as to what the regulation is trying to accomplish. And then the debate kind of shifts, I think, to a different level than it's currently conducted. And SROs are something that I think a lot about. And personally, I think self-regulation, if it's taking into account all of the relevant issues that are at play, putting the interests of the consumer first can be a very powerful tool. And some of the reasons that Gerry mentioned. I mean, a really effective self-regulatory body. I mean, there are always going to be a few bad players, but you guys are going to be far more aware of what it is they do and how they do it than we are as regulators sitting in our office towers. And frankly, even if we really, really engage strongly and effectively with you, and I think that that's a responsibility regulators do have, by the way, it still, needs the 95, 98%, whatever the number is, of the good players in the industry to be stepping up and recognizing the damage that comes to all of you if you don't ferret out the bad players. But I think one thing that's missing in the debate right now, or in debates that are going on around SROs, self-regulation versus, I'm not even sure what the right term is for us, but formal regulators, is that there's not a shared view yet in terms of the people who are debating as to what the objectives are. And I think that's where you need to go first and get that shared understanding of what it is the regulation is seeking to accomplish, and then start to talk about, okay, well, if protecting the consumer is the key thing, what's the most effective way, and what are the best regulatory structures to put in place?
Over here.
Question to Mary there. What I was wanting to know is I found in the last 6 months, especially, not so much in the insurance industry, but in the brokerage industry, the discussions around the water cooler, shall we say, is about the day traders going on, the heavy amount of trading, the day traders, that our markets are not being, are not the way they should be normally. And what is your department doing to regulate or control them? They seem to be very interested in controlling us, but here these people can get on a computer and do whatever they want, and it's affecting everybody's financial, equities, etc. I noticed that in Europe about 6 months ago, they limited, the regulators there limited day trading in financial stocks because they were going so volatile up and down, when that was, whatever they did put into it, seemed to calm the markets for a long time, and equities sort of, whatever normality is today, was okay. But here we've been, like, market swings are ridiculous, and I keep being told that it's, millions of shares being traded by people on a computer. They sell in the morning, buy in the afternoon, and a legitimate person wanting to invest doesn't have a clue what to do anymore. Thank you.
Well, thank you very much for the question. I think you're absolutely right that this is one of the many ways in which the markets are changing very rapidly. And certainly the issue of high-frequency trading is on the radar screen of the securities regulators. Our market infrastructure people, certainly have their hands full these days on a variety of fronts with respect to how the infrastructure is changing. But that is one thing that they are monitoring quite actively. Howard Weston is going to a conference in Europe in a couple of weeks to try to have a conversation with a number of other securities regulators around the world in the US and the EU precisely on those kinds of issues, dark pools, high-frequency trading, because we're aware that this is something that is changing the way in which the market operates. So we're certainly looking at it, and we're trying to get a sense of how much a factor in our market in Canada this is as compared to other jurisdictions, and I think we'll try to respond to that once we've gathered some information about the extent of the problem.
Thank you.
Over here.
This is a question mostly for Mary and Gerry. In regards to increasing financial education and financial knowledge of consumers, would there be an increased role for the Securities Commission and the Insurance Council to act in this regard? And if so, would you have plans to be increasing information on the website or producing documents to ensure that there's timely information about changes in regulations, for example?
I'm happy to answer that. So I think there were two parts to your question, if I understood it correctly. One was sort of the role of the regulators in improving financial information generally, and then specifically new rules and regulations. So to get back to my comments about the Investor Education Fund, the Securities Commission, is the primary funder of that fund, and they are doing actually, I think, quite significant work in the social media area to try to target useful financial information to different demographics. So the kind of information you need if you're a young person leaving university, starting work hopefully with debt to consider, people looking for housing, and then obviously as moving towards retirement. So they have tried to carve up the space of financial literacy so as to really target useful information to people at different stages in the life cycle. And so to the extent that the OSC is the primary financial supporter of the efforts of the Investor Education Fund, I think we see ourselves as being quite active in that area. With respect to the more specific question about knowledge of new rules and regulations or assisting consumers and investors to know how the landscape is changing, I think you're right or I think the implication is that in the past we sort of relied on putting rules up on our website, and there are 50, 100-page rules, and we sort of expect people to navigate what exactly is meant. So I think that you're spot on to acknowledge or to force us to acknowledge that we need also to be a bit more user-friendly in the way that we communicate new rules and new approaches. So we are trying to do that in a number of ways. In the last year or so, different divisions within the OSC have started to try to use more of a guidance model, a sort of a 3 or 4 page summary of issues that they have noticed that are coming up, in a trend type way, and then trying to provide some guidance as to how the regulators would respond to a document coming in that had some of these sorts of concerns in terms of not adequate disclosure about what the investment strategy was or something like that. So we're trying, in short, we're trying to experiment with more user-friendly types of documents that provide guidance both to people who are sort of repeat players in the industry, but I think also, as you're suggesting, it would be useful to do the same for investors as well, and to try to direct them to a better understanding of what it is they can expect from people that they encounter in the industry.
Yeah, and in BC, we're sort of taking the same approach. We are currently sponsoring a part series of articles on financial literacy that are being run by one of the local papers in Vancouver. And our plan is to do an additional series starting in 2012 that are aimed towards consumers understanding the importance of insurance, the different products, and trying to prepare articles, I guess, that they will understand and be easy to read. I spent 20 years trying to come up with ways in which you can educate the consumer. The one thing I've learned is the consumer only wants to learn something after they've made a mistake, unfortunately. And those that do want to learn it right off the bat. We used to go to something put on by the Better Business Bureau, and we had a booth there and talked and met with people. The one thing we learned is the people who went to these seminars were the people who were already informed and looking for more. It's been trying to find a way to get to the people who don't know it, who need the information. So, like I said, one of the steps we're taking is to run a series of articles in the papers in the province in hopes that we can get a better understanding of it. But again, it's the mentality of all of us is that we learn things when we want to know them and not necessarily when we should know them. From the standpoint of educating the agents, we certainly encourage everyone to access our website. We put everything up on there. We have slowly acquired everyone's email addresses so that we can provide information and changes. We are designing a number of courses that we are going to provide and keep going, and one of the things that we're considering is making certain courses on regulation mandatory as part of the CE so that every new agent will have to take courses that we have designed, and we'll encourage people to keep taking them so they can keep in touch with what is going on. It is a challenge. Like I said, it's finding different ways in which we can provide the education, educate them in a way that they will understand it. And we spend a lot of time and effort trying to come up with good ways of keeping both the consumers educated as what they need to know, as well as keeping the people we regulate aware of what changes are going on.
Thank you.
We're remarkably on time, and I think we have time for one more question. So, Al, if you'd like to...
I want to thank the Rockstar panel for being here today and doing what they've done. This question's for Gerry. Now, Gerry, I must preface, I am from Ontario, so I'm seeking some clarity. I appreciate what you're doing in BC, specifically about introducing the supervision for newer agents, and I think that's exceptional. I think that's great work. My question, though, a level playing field is important, and I know in BC there are a lot of credit unions, and I know you have a few banks in BC. Is the expectation the same for those people that are working out of the credit union to be under supervision for 2 years before they're engaged? I don't know where you sit in BC.
If you are required to have a license in British Columbia, and a number of credit unions and a number of banks have licensed people selling insurance, they will have to obviously fulfill the same requirement. And I believe, as I said in my presentation, we think most people are under some level of supervision. But if they're not, then they will have to be. I think if you're alluding to the fact that there's also an exemption that exists in our legislation that allows financial institutions to market credit insurance, which is basically life insurance, that is a decision of the government to decide whether or not they wish to get rid of that exemption. But as long as that exemption is there, then they do not fall within our jurisdiction, and there's nothing I or the council can do about that. But for those people who have to have a license, it will apply regardless of who you work for.
Well, Gerry, Mary, and Phil, I just want to thank you very much for a fantastic discussion, presentations. It's always enjoyable listening to the regulators and hearing what they have to think on these sort of topics. So thank you very much for joining us today.